Hi, this is Sylvia, and in this video I'll try to explain the difference between a contract asset under IFRS 15 and a trade receivable. Today's question comes from Raj from Nepal. What is the difference between contract asset and a trade receivable? I know that contract asset is a new term under IFRS 15, but I just don't understand when we should account for a contract asset and when to account for a trade receivable. Isn't it the same? The answer is no, it's not the same thing. And in this episode, I'll try to explain the definitions of both terms and try to explain in a simple human language with common sense what the difference is, right? And then I will try to illustrate it with the example. So contract asset is the term defined by IFRS 15 as an entity's right to consideration in exchange for goods or services that the entity has transferred to a customer when that right is conditioned on something other than the passage of time, for example, the entity's future performance. And the trade receivable or account receivable is a financial instrument as defined by IAS 32 as a contractual right to receive cash or another financial asset from another entity. So you can see from these definitions that the main difference between the contract asset and a trade receivable is conditionality. Contract asset is a conditional right, while a trade receivable is an unconditional right. And let's omit the passage of time for the purpose of these explanations. Okay, you might think, but what the heck does that actually mean? When should you account for a contract asset and when for a trade receivable? Well, okay, let me translate the definition to the human language. A contract asset arises when you, as a supplier, have already performed something. You delivered part of the services or goods as agreed, but under the contract, you still have something to do before you can actually bill the client. So imagine you agreed to build a hotline center for your big client, and the project will take 9 months and starts on 1st July. The contract price is 100,000 currency units. And in that contract, you agreed that the customer would pay you for the whole project when the hotline is complete and hand it over to the customer. Okay, that's a bit unrealistic, but let's keep it simple just to illustrate it. And at the year end, you have been working on the project for 6 months, and under IFRS 15, you need to recognize the revenue based on the progress towards completion, because this is a typical situation of the revenue recognized over time. So you assess that the project is 70% complete, you book 70% of the total price, and that is 70,000 currency units. What's the journal entry? Well, the credit side is the revenue. But what's the debit? Well, a contract asset, not a trade receivable. And the reason is that at the end of the year, after only 6 months of work, you do not have the unconditional right to a payment. The condition that you must meet before you get paid is to complete the project. And at the end of the year, this condition has not been met yet, so you cannot recognize a trade receivable. Instead, you debit a contract asset. And the journal entry is debit contract asset with 70,000 currency units and credit revenues with the same amount. And then you work for another 3 months. You complete a project and hand it over to the customer. And at that moment, you have an unconditional right to a payment and not a contract asset of any kind. Also, you have to recognize the revenue over time for these remaining 3 months. So what's your journal entry? Well, you debit trade receivables with 100,000 currency units because the unconditional right to a payment was created by handing the project over to the customer. And then you credit contract asset with 70,000, well, because your conditional right created last year turned into trade receivable, or the unconditional right. And you also credit revenues with 30,000 because you need to recognize the revenues for the last 3 months based on the progress towards completion. So I think that by now you should have a good understanding of the difference, and I published a nice full example on construction contracts on my website. Well, you will see also the contract assets and trade receivables there, so don't forget to check that out. Last but not least, contract asset is not a financial instrument, so IFRS 9 does not apply here, with one exception: impairment. So you have to assess the contract asset for any impairment, determine the expected credit loss, and recognize a loss allowance, exactly as with any trade receivables that you might have. So that's it for today. Please read our disclaimer because I have to add it here. And please share this video with your friends if you believe it can help them. Spread the love, and feel free to visit CPDbox.com, sign up to our free newsletter, check out our courses, articles, and many responded accounting questions. Bye bye, and thanks for watching.